If you're thinking about trading, I'd encourage you to watch this through to the end. Not because I'm going to sell you a magic system, but because this could save you from making the mistakes that drain your hard-earned money. The stock market isn't gentle. It's risky. And the reality is, up to 90% of traders lose money over time. And here's why that happens. Most beginners don't lose money because they're unintelligent or because the market was bad. They lose money because they never slow down long enough to learn how the best traders protect their capital. The information is out there. It's public, and it's been tested for decades. But instead of studying what top traders do when things go wrong, beginners rush in and pay for their mistakes with real money. I've seen this up close. A friend of mine lost a huge amount of money simply because he never took the time to learn how to protect his capital. And you can see the toll it takes on him every day when he has to face his wife and explain what happened. I'm not here to point fingers. I made the same mistake when I started. I followed bad advice and let emotion take over. In short, I was trading like a mindless zombie. If you're new to trading or you're wondering why you keep losing money, this video is for you. The purpose of this video is to help you protect your money in good markets and bad. So let's get started. At some point, you want rules that actually work, right? Rules used by traders who've already proven themselves. One of the most respected names in trading was William O'Neill. One of his protégés, David Ryan, went on to win the U.S. Investing Championship. Not once, 3 times. Another trader with a slightly different system, but the same disciplined mindset, is Mark Minervini. He also won the U.S. Investing Championship. Twice. Now, not all trading systems are the same. Traders approach the market in different ways. But when you strip everything else away, the best ones agree on one rule above all others. Protect your capital first. Sorry about sounding preachy. William O'Neill makes this point clear in his work, and Mark Minervini lives by it. This is how Minervini thinks. He doesn't begin by asking, "How much money can I make?" He starts with a very different question. How much can I afford to lose if I'm wrong? He has a ritual that keeps his ego in check. Every morning, before the market even opens, he looks at himself in the mirror and says, "Mark, you have the capacity to do serious damage to yourself today." Then he goes to work. That moment is a warning, a reminder that trading can hurt you fast if you forget the 2 most important words in this game: respect, risk. And here's why he thinks that way. Most people assume the best traders are right almost all the time. They're not. Even Mark Minervini has said that, on average, his win rate is around 50%. That's an eye-opener, isn't it? Half his trades don't work. And he's still one of the best. This changes the way trading really works. If someone like Mark Minervini, a 2-time winner of the U.S. Investing Championship, expects to lose money on about 5 out of every 10 trades, think about what that means for the average trader, or someone just starting out. That's why protecting your capital isn't optional, it's survival. I know what you're probably thinking right now. If Mark Minervini is only right about half the time, how is he making serious money at all? Shouldn't he just be breaking even? And this is where elite traders separate themselves from everyone else. Mark Minervini doesn't win by being right more often. He wins by how he handles being wrong. Even with a win rate around 50%, there have been years where he's produced gains of 200%. And we're going to see how the top traders make sure losing trades don't wipe them out. More importantly, you'll see how those same principles can be applied to your own trading decisions. Here's the idea. Imagine flipping a coin. Heads, you win $1. Tails, you lose $1. How long would you keep playing that game? Probably not very long, right? You don't need to be a mathematician to see what happens. Over time, you go nowhere. You just break even. and after a while, it feels pointless. Now change just one thing. Heads, you still win $1. But on tails, you only lose 50 cents. Suddenly the game changes. You can be wrong just as often and still come out ahead. Nothing magical happened. You didn't predict better. You just controlled the downside. That's the difference between guessing and trading. So how do you apply this to your own trading? Here's the key point. Choose one clear strategy and actually take the time to understand it. Maybe you're drawn to William O'Neill's approach. Maybe Mark Minervini's method makes more sense to you. Or maybe you follow a different mentor altogether. What matters is that the strategy has a real, proven track record. And once you start applying that strategy to your own trades, everything comes down to one thing. Keep your losses small. So how do you do that in practice? I'm going to keep this simple and approachable. No complicated formulas or heavy theory. This isn't about becoming an expert overnight. It's just about giving you a clearer picture of what matters, so you can avoid the mistakes most of us make early on. The first step is to understand what a reasonable win looks like for you. Maybe your winning trades average around 10%, maybe 20%. Occasionally it could be higher, but for beginners, big wins are rare. That's why you need to track your trades and calculate your average gain. Let's say over time, you find that your average winning trade is about 14%. Once you know that number, the rule becomes simple. Your losses should be much smaller than that. Ideally, about half or less. In this case, that means a stop loss around 7% or lower. You're not trying to be perfect. You're just making sure one losing trade can't erase the progress from a winning one. So if your batting average is 50%, that means out of every 2 trades, 1 wins and 1 loses. If your average win is about 14% and your loss is capped at 7%, the math works in your favor. You make 14% on the winner, you lose 7% on the loser. Net result? You're up 7% over those 2 trades. And that's how you can be wrong half the time and still grow your account. In practice, this means using the stop-loss feature built into your trading app. Before you place a trade, you decide where you'll exit if it goes against you. And you enter that stop right away. Not later, not after you see how it feels. This way, the decision is made while you're calm, not emotional. Once the trade is live, the app does the hard part for you. If the price hits your stop, you're out, automatically. It's one of the simplest ways to protect yourself from small losses turning into big ones. But please keep this in mind. This isn't something you set once and forget. You need to keep checking your trades and adjusting your stop losses as the market changes. Sometimes the market is calm, sometimes it isn't. When conditions are tougher, your profit potential is smaller, so your stop loss should be tighter too. Even then, the top traders we talked about are very careful. They rarely risk more than about 8% on a single trade. And just to be clear, this is for trading, where you buy and sell stocks within a year. Long-term investing follows different rules. You'll hear some gurus say using a stop loss is dumb, that it knocks you out too early. But Mark Minervini strongly disagrees, and so does William O'Neill. Imagine this. You get stopped out of a trade because your stop loss is triggered. The next day, the stock explodes higher. You look at the chart and realize you could have made $50,000 if you just stayed in. And now you're kicking yourself, replaying it over and over in your head. This is where a lot of amateur traders get trapped. After getting stopped out a few times, they decide stop losses don't work. So on the next trade, they don't use one at all. When the stock drops 7%, they tell themselves, I'll wait. This one's a winner. A few days later, it's down 12%. Now, the plan changes. I'll sell when it gets back to break even. But the stock doesn't care about your plans. The following week, it's down 18%. At that point, fear takes over. Selling feels painful, holding feels reckless, and the trader freezes. I've seen this play out in real life. My uncle put a large amount of money into a single stock and rode it all the way down to a massive 90% loss. He's still holding it today, waiting for the day it gets back to break even. Okay, that image is exaggerated, but you get the idea. But sadly, this is how many people end up trading. Their logic fades, and instinct and emotion take over. Zombie mode. I'll be honest, I made the exact same mistake when I was younger. Stop losses protect more than your account. They protect your sanity. If you tend to get emotionally attached to your trades, like I do, they help you sleep at night. Because when losses are capped and controlled, they stay small. And small losses are manageable. The most important thing is this. You still have the bulk of your hard-earned capital intact, so you can stay in the game. There's one more thing Mark Minervini stresses if you want to avoid getting stopped out unnecessarily. Stay away from what he calls bucking broncos. That's his term for highly volatile stocks, the kind that swing wildly from one day to the next. They don't just test your stop loss, they test your nerves. Of course, this video doesn't cover everything there is to know about trading. It's meant to give beginners a solid starting point for understanding risk management. Traders like Mark Minervini and William O'Neill go much deeper in their books, with charts and real examples that are well worth studying. My goal here is simple. I don't want you losing money just because a friend tells you a stock is guaranteed to take off next week. You already know that trading on tips is a bad idea. The safer path is always the same. Do your own research, manage your risk, and protect your capital first. One last thing to keep in mind. Learning how to trade stocks is a serious skill. It's closer to earning a college degree than picking up a casual hobby. I'm not exaggerating. For most people, it takes years of study, practice, and real trading experience to get it right. And the truth is, earning a steady income from a full-time job is far easier than making consistent money trading, no matter how many gurus tell you otherwise. If you want no-nonsense guidance on managing your money, explained in a way even a zombie can understand, please like this video and subscribe to Rador's Wallet.